Hey, it's Jeff Hyman with Startup Therapist, and we focus on the people part of startups. And today we are here with Stuart Frankel. Hey, Stuart.
Hey, Jeff. How you doing?
Very well. Thank you for joining us. Stuart is the CEO and co-founder of Narrative Science, a very successful, well-funded, early to mid-stage company based in Chicago. And in a moment, I'd love for you to tell us a bit about what you do. And we're going to talk about Stuart's learnings in building this company over the past 5 years. But prior to starting Narrative Science, Stuart was with Performix, which was a big division of DoubleClick, later acquired by Google. So you've been in and around the tech space for quite some time. And I think I understand you're also a recovering attorney and accountant. Is that right?
I am many years ago now, but
Wow.
yes, to both.
I'm assuming you don't miss that too much.
I don't.
Good. Well, with that, why don't we get into it and start with an overview of Narrative. My understanding of the best way to describe it is you take technology that kind of is a natural language generation, and you can generate content and articles and analyses for companies. But I don't want to misinterpret it, so maybe we could put it in your own words.
Yeah, no, that's a good start. So we're an enterprise software company, and we've developed a technology application that we describe as an advanced natural language generation platform that we call Quill. And what Quill does is it takes data, primarily structured data, looks at that data, figures out what's interesting and important in that data, and then renders that analysis, if you will, in a natural language document. And a natural language document might be anything from a tweet about a sporting event to a 20-page investment research report that looks and sounds like a Wall Street analyst looked at a stock, conducted research, and wrote up the analysis.
Amazing. So in layman's terms, just to give an example, Stuart, how would the software go through content to extract the most important or salient points?
Well, so importantly, it goes through actually data. So it starts with data as opposed to starting with an existing document. And it looks at that data. And Quill is a configurable technology. So based on the domain that we're focused on, for example, financial services is an area that we do a lot of work. Quill will look at meaningful information that's contained within that data by applying a series of appropriate analytics, pull out that information, and then much like a person would look at that analysis, will actually construct a document with the most important information to communicate the results.
Amazing. I can only imagine where this will be 10 years from now. But you're clearly on the leading edge of this. Just to give a sense of size and scale, how big is the business in terms of number of employees and also capital that you've raised?
So we've got about 80 employees. Most of those folks are here in Chicago. About half of those people are software developers or other technologists. And we've raised a little bit north of $30 million from a group of great VCs, including here in Chicago, Jump Capital, but Battery Ventures, Sapphire Ventures, which is part of SAP, and then some other folks as well.
Okay, so those are exactly the two main topics that we're going to focus on today over the next 10, 15 minutes is talent and recruiting and building an organization and a healthy culture, and also a bit about fundraising as well, if that's okay. Why don't we start with recruiting? So you're at 80 people. What have you learned over the 5 years of building this wonderful enterprise about how to build a culture, how to build an organization that's marching in the same direction? I'm sure you've made a lot of mistakes along the way. What can entrepreneurs learn from your experience of doing that?
Yeah, well, so I think obviously in a company like this, in a technology company, it really does come down to the people. So you have to get that right. And I will tell you, it's very difficult to get that right. I don't sit here today and really hold myself out as an expert at recruiting or career development or all those things, because I think it's one of the most difficult things to do. I think in terms of attracting talent, though, you have to have a couple of things. One, you do have to have a clearly articulated mission people want to come into an organization that really has a good idea of where it's going. Even if, in fact, that changes over time, it's important to get people behind the same mission. I think it's important to articulate the values of the organization. This gets a lot of lip service. We have spent a lot of time working on this. Our values are communicated regularly to people. We make that a part of the evaluation process when we're interviewing people, when we're reviewing people during a performance review. We look at that stuff.
How did you first define that culture? So you're at 80 people now. You've got a culture. You were the co-founder of the business, so it was you and a laptop at a Starbucks. How do you define or codify that early culture?
Well, we didn't really codify it at first. I think again, we had a very interesting technology, and one that frankly was one of the first of its kind. And that in and of itself attracts a type of person, particularly on the engineering side of the business, who want to come in and really work on a challenging problem, one where there isn't necessarily a clear roadmap. And so that really allowed us to attract very good engineering talent early. I also started the company with 2 computer science professors from Northwestern who have a great reputation in artificial intelligence and natural language generation, natural language processing, and that helped attract that talent as well.
So you set out a big, meaty challenge for these technical folks, and you feel that was instrumental in drawing them in.
We did. We wanted to really build something that was impactful, revolutionary, ultimately ubiquitous, really from day one of the company, and that certainly attracts a certain kind of people. But I will tell you, the people that you attract at the very early days of a company are very different than fast forward 5 years later. You've got 80 people now. We've got a lot more structure to the organization. So we're now recruiting. Go ahead.
Help us understand the difference. In other words, have you actually parted ways with people along the way, or maybe they opted out because of the going from 5 people to 80?
Yeah, I think we're fortunate. We actually have a number of people that when we started the company, they're still with us, but we've certainly had people leave the organization as well. And as you know, Jeff, from being an entrepreneur yourself, people leave organizations for a whole bunch of reasons. We tend to have people who are relatively earlier in their career, and so over time, people leave because they move out of town, their spouse gets relocated, they go to graduate school, and we're no different than other organizations. Although our turnover is actually very, very low. We've done an okay job of helping people who have been here for a long time really make sure that they continue to have a meaningful role. But the reality is that, by definition, roles tend to get narrower as the company matures, right? Sure. There's just more structure that's put into the organization. And some people really desire a much more early kind of undefined experience.
So when people leave to pursue that, let's say other startups or smaller companies, how do you message or convey to the rest of the organization that that's okay? It doesn't mean there's a problem. It doesn't mean there's an issue, but it's a natural part of the life cycle of a business.
Well, one of the ways we do it is exactly really what you said, is to really try to explain to people that there are things that occur in every organization, even really great organizations. And the truth is that some amount of turnover is healthy. You want people over time who have been here for a long time and aren't necessarily the right people to continue with the organization. You do want them to leave and pursue something else, both not only for the company, but also for themselves and their own growth, and that creates opportunities for people who are here, or new opportunities to bring other folks into the organization.
When it comes to recruiting, let's call them rock stars, people that come in and they are just your top performers. What have you found, or what have you learned are the keys to those people functioning in a early stage startup that's still kind of coming together? It's like Jell-O a little bit. What characteristics do you look for, and what have you found?
I mean, I think whether it's early stage or even later stage, I think that A players tend to be A players, and people at those various stages share somewhat common characteristics. I think at its core, people who are have grit and they're resilient and they're comfortable with ambiguity, those are really table stakes. Those attributes have to be there, or people just won't be able to, frankly, handle the pressure and the uncertainty that comes with both a startup, but even more mature organizations. I think it's pretty critical, particularly in the early days, for people to feel like an owner, and for people to have a desire to compete and a desire to win. You certainly do that by offering equity and making people literally an owner, but there's an emotional piece of that as well that I think is critical. And if that's not there, it's very difficult to be successful with people who are just coming in and treating this like a job as opposed to a mission or something just bigger than a typical job.
Since you're on the leading edge, kind of inventing or helping invent this category, how do you define winning for your team? Do you set out a particular company that is the enemy, like back in the day, Oracle, we're going after Oracle, or we're going after, Microsoft? Do you have a company that you kind of set your targets on so everyone's going in the same direction, or are you more focused on just building out this new thing of advanced natural language processing?
Yeah, it's a great question. I think a little bit of both. It's an immature market. It's a new market. There are very few players, so it's hard to kind of go up against that Goliath player and really get everybody kind of charged up to take on that player. But we certainly have folks that we compete against, and we compete hard, and we talk about that. But that isn't really our core focus. I think that what we have done is we've really brought in a group of people who almost, and I would say probably now to a person, have really an unwavering belief in our future, in the idea that this technology will become ubiquitous, that the world of big data and analytics and visualization, which is a space we play in, it's still immature. The solutions that are in market today are not the right solutions. They're being underutilized. People struggle, even though they have access to all of this data. And we have something that can really help kind of bring that market along, and also, frankly, make a lot of those tools and a lot of that investment really worthwhile and more useful.
Let's talk a little about product market fit in the early days, and then we'll go to fundraising and capital. I think you've told me that a lot of your business is in financial services. That seems to be a good vertical. Early days, did you know that? How did you find that product market fit? How did you realize, hey, financial services companies can benefit most from this technology, and those are the ones that we should focus on going after?
Yeah, well, we started actually focusing on media companies. So the business really started out creating long tail news content for media organizations, sports stories, financial news, real estate news, other areas of news that were data heavy, and where there was a market for that type of content. In large part, that was driven by how the company started. We came out of Northwestern. We came out of both the School of Journalism and the School of Engineering, and we very naturally gravitated towards working with media companies. Over time, as we got a lot of exposure, and the joke that I'll often tell is, if you want to get a lot of early press as a startup, do something that disrupts journalism, because reporters can't resist writing about that, right? And that happened, and so people wrote about us, and it raised awareness of the company to the point where we started getting calls from large companies across every industry, certainly financial services, but also marketing services, the U.S. intelligence community, manufacturing, marketing services, all describing really the common problem of, hey, we got a lot of data. Can you help us really figure out how to get insight from that, from that data? Got it. And so that really started to move us more towards an enterprise software company.
So you followed the money. You listened to what the market was telling you in terms of where the demand was.
Yeah, we absolutely did. We've built a really amazing technology. It's a completely horizontal platform. It can be applied to any vertical, any subject, any topic. But you can't go to market that way.
Yep.
You have to really focus your very limited and precious sales and marketing efforts towards a particular vertical or two. And so we really picked financial services a couple of years ago. It's not to say we're not in other verticals. Yep. We are. But when you look at where a lot of our effort goes, it's toward that one core vertical.
Almost like declaring a major in college, right? You got to have a major. You can take electives and do whatever you want, but you got to declare a major.
Yeah, I think that's a good analogy.
Let's switch to fundraising just for a few minutes. You've raised $30 million or so in capital from top A-tier venture capitalists. What have you learned that entrepreneurs could benefit from about when to raise capital and how much to raise in each round?
Yeah. Well, I think obviously it depends on the business that you're in and the capital needs, and the capital needs of the business. So, because we're an enterprise software company and because we had to build something, we weren't able to come out of the gates with revenue, meaningful revenue on day one. We have been really focused on proving our business model and focused on building a business since day one, but as you know, that can be very challenging to do when you've got to build this technology first. And so we really needed capital very early. And, we did, I think, a classic seed round that was funded by, some individuals that I had previously worked with, myself, a couple of folks who would eventually join our board,
yep.
And then one or two just smaller institutions who do that kind of investing. For us, that first round was really proving we could take technology or a prototype of our technology out of a university and move that into the commercial realm. And so we had a very specific milestone. And
it was a proof of concept, basically.
It was, yeah, it was. And I think that it's important to put these milestones out there that help you determine and create that roadmap for when you raise money.
Yep.
It might be based on the product. It might be based on sales if, in fact, you're able to get to market very quickly. But what that allowed us to do was actually build the technology or build the first commercial version of our technology, but also be out there in the world for a year or so, talk to prospective customers, talk to prospective partners. And really, in my mind, it was determining, hey, I think there is really a market for what we're going to do here.
What are the benchmarks you hit that made you say we can and should go for our next round of capital?
Yeah, for us, as I mentioned, it was really the product. It was getting the technology to the point where it was truly a horizontal technology, and we could start to generate natural language across many different topics.
So it was not a revenue metric or a size metric. It was proving the product worked.
Proving the product worked. But one of the proof points was, in fact, getting a couple of commercial, customers, paying customers, which we did. And once we did that, I really felt like there was an opportunity out there then to grow the business. As you know, every business isn't necessarily designed to be a VC-backed business.
Sure.
Can't support that level of capital investment because the market isn't big enough, or various other attributes in that market. I felt pretty good based on my prior experience that we had something that we could get funded, and that the taking outside capital was really a necessary part of our ultimate growth.
I'm sure you got turned down by VCs. You didn't bat 100%. What were some of the reasons people told you that they were not going to invest?
Yeah. Well, look, I think whenever you raise money, you get mostly no's. There's no question. I think for us, we're doing something brand new. It was hard to point to other companies in the market that were doing similar things that already had an established customer base and already had proven success. VCs they want to de-risk, obviously, their investments as much as they can, and one of the ways they do that is they look to existing markets, and they look to see that the size of the market has already been proven,
right.
And then look for entry points into that market. we were building something new in a new market. So right there, there's a couple of strikes. There's a couple of strikes against you. But then just even more practical things. When you're out there raising money, you may not realize this, but timing is everything with VCs. Where they are in their fund, what their industry focuses on. Are you talking to the right person at the fund? Is this a person who's winding down and may want to not do investment? So there's lots of reasons to say no, and certainly people said no to us.
Last question: what was the single biggest mistake you made during your financing rounds? There've been multiple rounds, but if you can go back and change one thing about kind of the way you went about fundraising, what would it be? Raising too much, too little, the wrong time, the wrong people?
Yeah, I would say we've been very fortunate. What I can tell you at Narrative Science, and I feel like we've got certainly the right people around the table, the right investors. When I look back earlier in my career, and you hear this all the time, but I think it's absolutely true. You really need to focus on the individual that you're going to be working with. If it's at a VC. The individual at the fund, because that truly is the person that you're dealing with. And while VCs will often sell the idea that it's a team, and in fact maybe it is, really 99% of your interaction
is with that one person, that partner.
is with that one person. And again, I've been very fortunate, but in the past I haven't necessarily been as fortunate. And I think that is one of the critical things to focus on. So when people ask me, hey, is valuation important, the most important thing, or is the preference, the mechanics of the preference the most important thing? I always say, listen, I will kind of give on those a little bit to really have the right person, sitting around the table.
Got it. And chemistry fit with your culture is a huge piece of that.
Yeah, absolutely.
Stuart, this has been fantastic. It's a good broad range of a very successful case study in the making, and I appreciate you taking the time. How can people learn more about Narrative Science or about you, or potentially become customers?
Sure. Well, we certainly have a website, narrativescience.com, which is easy to find. We've got a big Twitter following, and we tweet lots of information about the company at Narrative Sci, and then people can reach me at sfrankel@narrativescience.com.
Stuart, thank you so much. It was fantastic.
Thanks, Jeff. Good talking to you.